spend this chapter of the pod like talking about most bearish case, middle case, most bullish case, and then overlay that what you think, and then what again the meta, what the rest of the market, Jamie Dimons of the world, hedge funds, and foreign investors think. I know it's a difficult exercise, but let's just spend a moment on that.
I think the most the most positive to me would be this lockstep, stair-step approach to affecting the growth negative, but sort of long-term sustainability viewed initiatives like reducing the budget deficit, which when the government spend less, that's just bad for stock prices and GDP growth. That's just the equation. So they need to slowly bring that down over a year or two, and that will help calm the bond market. That will help, lower the cost that the U.S. has to pay to finance their debt, because people will be less concerned about fiscal sustainability. They need to do that in kind of conjunction with some of these positive pro-growth tax extensions from their previous bills, and then the deregulation initiatives, which they've already started on the energy front, cutting deals with the Saudis and opening up additional drilling and sources of energy, which helps anchor inflation, bring inflation down to offset any near-term impact of tariffs that might be inflationary, because you reduce the input costs, and do this in a balanced way throughout the remainder of the year. I would say the most bearish is one where they feel too pressured because of maybe midterms in 26, or that would be the date, really, midterms 26, where they say we need to tear the Band-Aid off and tear it off quickly, because not only does it become a threat to our long-term initiatives if this is running into and around midterms in 26, but the longer this goes, the more likely there's problems either in actually achieving what we want and or cutting into the economy deeper and a worse recession or growth outcomes. And so if they have that view, they might want to really, cut once deep type of thing now and be more willing. I think Trump showed he was more willing to eat pain than anyone, even myself, who expected this sort of scenario to be. And they really want to put these things through and really backload all the tax and pro-growth, pro-markets things into the later part of the year. So I think that's most bearish. The problem there is you really hurt receipts, you hurt growth, you hurt the labor market, and you almost tip us too far negative growth that you have to then respond with bigger stimulus, worsens inflation, et cetera. So the most optimal outcome is really long-term for asset prices to be pretty range bound and choppy this year, not blasting to new highs where inflation's an issue, or, cratering where recession is a scare, but just sort of maneuvering it in a responsible way. But I call it the controlled burn efforts, with the risk being that controlled burns can become uncontrolled, and then you have to do things you didn't want to do.
Yeah, Felix, before we go to you, maybe I just want to entertain Quinn. I didn't hear any about the geopolitical risk of like just China, Taiwan. That could really just derail. I mean, just for
Yeah.
context, Taiwan produces 60% of all the chips in the world, 90+% of all the very specialized chips. There's a facility in North Carolina that actually like produces high purity quartz, which is actually the choke point of the world. But Taiwan is, for all intents and purposes, like. But geopolitical, I don't know if you didn't talk about it. You or Felix want to talk about it.
The reason that he needs, or their belief is that they need to get the Western world all together, is if they want to go after either the decoupling or confrontation against China in some form or another, they need everybody on board for this. Because look, we're at 150% tariffs on China now. When we get to those levels, we start to see diminishing levels in terms of the calculus for rerouting shipping. Regardless of where we're at now, we're already at the calculus where that trade is going to be rerouted through Vietnam to avoid those tariffs. So it's not a coincidence that if they want to get all on board on isolating China and actually having these 100+% tariffs actually be meaningful, they can't just reroute through the other countries. So they need every other country aligned there. So if that happens while we get marginally lowered net trade impact, let's call it, for these Western countries. And then they all focus on getting this deal done with China that could potentially lead to these lowering of tariffs of 150%. I think that provides a really good off ramp for this whole situation, and hopefully we can recalibrate the global economic trade order within those realms. And that's, I see, the key goal. So the issue is getting to that point without people losing faith in the U.S. bond market and U.S. capital as a whole, and that's where we're starting to see some testing of that right now. So I've been really focused on the bond market this week for the last few days, because what we've seen is that there's a lot of leverage built up in U.S. Treasuries. We have something called the basis trade that hedge funds put on, where they buy Treasuries and then short the futures and collect the spread, similar to Athena for crypto natives. This is the original Athena, and hedge funds lever that up like an insane amount. And then there's also some more idiosyncratic and more technical trades too, and around like swap spreads, but similar ideas. So the idea is there's a ton of leverage within the U.S. Treasury system, and then as we start to see this question of there's a lot of people coming out with these I'm still going to call it a conspiracy that China is just selling all their bonds onto the open market right now. These cross currents are effectively creating a lot of volatility in the bond market, and during this dynamic, if they start to see the long end really start to question the faith in this trajectory that is the bull case I just panned out, you can get to a point where the comparison that's being brought forth right now is what happened in England a couple of years ago with Liz Truss, where they brought in some fiscal concerns, huge deficits, and that caused the bond market to basically go on strike, to the point where the Bank of England had to step in and do temporary quantitative easing overnight. So the risk is that this accelerates further down that path and they lose the bond market, because this goes against the entire goal of Scott Bessent, which is he says focus on the 10-year. We want to get the yield of the 10-year lower. So you have to basically try to toe this line of getting to that endpoint of these negotiations and squaring in on China without losing the bond market, and it's a tough one.